This podcast is intended for investment professionals only. Hello and welcome to this episode of Market Talk for the month of June. For those old enough to remember the musical Carousel, June is busting out all over. And with strong equity rallies in Hong Kong and US last week, could that be true? Maybe, maybe not. Let's not forget that central bankers continue to walk the tightrope between growth and inflation. The S&P continues to grind higher, driven on the whole by a narrow leadership of stocks. And bond yields remain elevated. So what is the latest economic data telling us? Have we revised our current thinking on asset classes? And while some of us may be distracted by the wealth of upcoming sporting events from across the globe, will central bankers keep their eyes firmly fixed on inflationary targets? Asking the questions is me, Frances Watson, and joining us on the road, where he's seeing clients in Asia currently, is Bennett. Ben, the first question I have to ask you is, can you hear me? Is your sound okay?
Yeah. I apologise in advance. It's a little bit tinny here, but we'll struggle through. And it's been a fascinating last few days, I'll tell you that.
Yeah, well, it has, hasn't it? And let's just start with last Friday's jobs data, because we had a good rally on the back of those, Ben. But unemployment actually ticked up. So what's going on?
It's really weird. I mean, I don't want to get too technical about this, but the US monthly payroll report is actually derived from two different surveys. And the two surveys told diametrically opposite things, in effect. One of them said that there were loads of jobs created, but much higher than expected. But then the other one said the unemployment rate went up by 0.3%. Often, actually, even after the event, you'll look back at data and go, well, it was so obvious there was a downturn, there was a recession brewing there. Look at how bad this data, the jobs numbers were. But that's only because they get revised after the event. And the jobs data get revised for years to come. And you'll only really know what's going on in years' time. I suspect things are slowing down. I don't think we're in a recession in the US at the minute, but growth is probably flat right now. And we still do think that in the next, let's say 1 or 2 quarters, that growth will start to be negative in the US and start to head into a mild recession, because basically the US consumer has been running down their amazing savings during COVID, but they are running down quite rapidly. And I think they'll ultimately run out of money at some point. At the same time, interest rates are very high. People are paying more for their mortgages. And all that is sort of squeezing. That will eventually lead to negative growth in the second half of this year, I think.
Well, we know one thing for sure that's definitely slowing down, and that seems to be Eurozone inflation that we had figures last week. Is that going to shape ECB thinking, do you reckon?
Inflation is so hard to forecast, isn't it? So I think it's fair enough that the forecasters miss it by quite a bit every so often. It is incredibly hard. Last week, as you say, we had some headline inflation data was definitely lower than expected, even core inflation. So when you strip out big moves that we've seen in oil price, etc., stripping that out, it was also a little bit lower than expected. But it was lower than expected in France and Germany and Spain. It was actually higher than expected in Italy. So it was just wrong by the other way around. I remember a few weeks ago, it was so much higher than expected in the UK. So when you sort of look at Europe, the Eurozone plus the UK, it probably wasn't far away from expectations. And the levels are still too high, much too high for central bankers to get comfortable. So I think the ECB will still have a bias to carry on hiking interest rates, even at these elevated levels. And if they do, that continues to tighten, squeeze exactly what I was describing before, squeezing consumers, squeezing companies, making it more expensive to borrow stuff. You'll get less investment, less spending. And that is still in trade. I don't think these inflation numbers are anything close to what we need for the central banks to cut interest rates or ease liquidity. They still want to get a firm grip on inflation and see it properly come down before they ease the pressure.
Okay, and that meeting, of course, ECB meeting is next on 15th of June from memory. So look, commentators also looking at Chinese economy and slowing growth there. Was that behind the measures of targeted measures that were announced last Friday that haven't terribly well. I can't find a lot in the press about them, but they were there, weren't they?
Yeah, they came out and it says some sort of people in the know talking to one of the news wires about potential for more support for the housing market. And look, we know that the Chinese economy has been disappointing, certainly in the second quarter. Really had a great start of the year, January, February. I think it was a bit like everywhere else. Everyone got out and spent loads of money. Then that's definitely waned, and it's been disappointing, particularly the housing market. And I do think that the powers in China are looking at ways to try and re-stimulate that, because as it currently stands, we're looking at a pretty poor economic outlook for the next few months. So yes, talking about ways of stimulating their housing, but it didn't look to me as though there were any sort of big headline moves. So what I'm really looking for is a package where the local governments would be able to spend more on infrastructure. So we'd look at special local government bonds, and that if they announced the 1-2 trillion RMB of that, so huge numbers, that would be a proper stimulus. Here, I think it's at the margin, trying to make it a bit cheaper to buy a property, but we know the structural issues in China property will take a little bit more than a sticking plaster to sort out, I suggest. So I think we're looking at much more. We need something big, and we also need monetary support on the other side. So lower interest rates, potentially a cut in the reserves that bank have to hold at the central bank, that sort of thing. So for me, it was just marginal, but yeah, probably need to do more before I can get more comfortable with China.
So a trickle rather than a wave. Should we just go on to current thinking then? And I'm looking at the oil price, actually. I know it's bounced a bit today, but, you know, we've gone from 80s to 70s. And I'm looking at the yield curve and I'm thinking, well, the market is expecting a slowdown in demand, whichever way you look at those indicators, isn't it? But then I'm looking, as you say, some of the signs of the housing market, certainly in the developed world, still resilience, you know, in the labour market. How are you squaring the circle, Ben?
Yeah. As you said, there's a few different indicators there telling slightly different things. You're right. The oil price has been really weak, and I do think there's a lot to do with demand concern there. So China, in particular, around that, the interest rate curves have been inverted for quite a while now. So government bond investors also thinking about downturn, thinking about recession. Equity markets have been okay this year, but it's been very concentrated where the strength has been. It's been in the technology sector, and even within technology, it's been with the mega tech companies. Actually, a lot of the sort of peripheral technology don't seem to have had that same oomph from the AI and the fanfare that everyone's been talking about. It's really been concentrated in these big companies, which I don't fully understand. I'm not an expert in which companies are going to benefit, but I'd have thought it should be broader. So, yeah, what do I think is going on? Well, I think some of it is to do with liquidity, funnily enough. So up until last week, Janet Yellen was very careful about spending too much money because the US had this debt ceiling issue that needed to be resolved. And what she was doing, she was draining reserves out of the Federal Reserve. So they were draining their deposit account, in effect, taking out billions and billions of dollars and using that emergency cash and spending it. But that, in effect, had a sort of liquidity enhancing impact. And I do think that to some degree helped markets. It also probably helped some of the regional banks in the US that had seen deposits come out, and we know they've had some issues. That liquidity coming back into the system helped stem potentially those deposit flows. Now we've had the debt ceiling solution. So everyone's breathed a sigh of relief because we haven't got a US default. That's great. No one really thought that we were going to have a US default, but nonetheless, that tail risk is gone. But what that means now is that Janet Yellen is going to have to try and rebuild the emergency cash stockpile, take some money out and stick it back in the piggy bank. And that's going to withdraw some liquidity. So my thinking is that change in the liquidity from spending to withdraw might start to impact some of the areas that have seen an incredibly strong run over the last few weeks, maybe some of these AI type trades that we've seen. And I do think, because of what I described earlier, the recession, the second half of the year, I think the oil price has got that better, more accurately reflected. I also think that the interest rate market's got that more accurately reflected. And I think that ultimately will be reflected in equity markets. And we've got downside risk to equities in the next few months. That's my current thesis on how it's all sort of sitting together.
So in summary, while some are desperate to see this rally broaden out, particularly to global small caps, you don't think that's going to happen?
Yeah, no, I don't. And in fact, I think that maybe some of the winners could start to see their prices come back down to earth at some point.
Okay, well, we know what's definitely going to happen, Ben, and that's rate decisions this week. Namely, I think the Bank of Canada and Bank of Australia. Tighten or no tighten there?
Well, markets have got both Australia and Canada at unchanged. Australia could hike interest rates another time, but both are sort of in the pause camp and just waiting to see if inflation comes under control, which is probably the same camp as the US Federal Reserve. And that's just clearly a more important global central bank than Canada and Australia. And we're actually not that far away from their meeting, are we? Which is a week on Wednesday. So it's only sort of 10 days or so away.
14th,
and again, yes, exactly. And then chances are that they will be also in the let's pause and see how it's going camp. But at the same time, you've got high interest rates everywhere. You've got this potential withdrawal of liquidity, and there is a lagged impact of monetary policy. So, they're pausing because I think they are worried that they've already done enough. And I do think that they've done enough, all these central banks.
And of course, another thing to look forward to is Chinese inflation data, Ben. What's going on there?
Yeah, this week we've got on Friday, I think it is, Chinese inflation. It's just about the only country in the world, I'm sure there are others I can't think of, that hasn't got an inflation problem on the upside. If anything, it's got an inflation problem on the downside. It's staring deflation, certainly on the input, the PPI level, in the face. And another reason why the central bankers and the policymakers are probably going to look again and think, well, we need more stimulus, because we have seen in the past years and years, haven't we, most other central banks struggling with disinflation, deflation. It's taken them a long time. It took them a pandemic to get out of it, didn't it? So, maybe Chinese policymakers need to react more quickly to that. And again, we've mentioned the following week on the 14th, the Federal Reserve, the day before the Federal Reserve on the 13th, I think it's a Tuesday, isn't it? We get US CPI, which is probably, again, because the US dominates financial markets, the US CPI is going to be the most important inflation data point for the month as well. So let's see what that is. That could swing the Fed either way, from a pause to another hike.
Okay, well, another very important number that we always like to listen to is your number of the month. And I'm going to say number of the month because you're disappearing off on holiday at the end of the month, and I'm going very soon. So we have just the one market talk for June. So what's your number of the month, Ben, and why?
I mean, we've been talking about the US and China a lot, and I've mentioned numbers in the month with those two countries in mind as well. So there was another one that sort of took my breath away, really, and it's the difference in performance between the NASDAQ, which is the US technology sector, and the Hang Seng technology subsector. So it's the technology companies within the offshore Chinese companies listed in Hong Kong. And the difference in the performance so far this year between those two markets is 40%. Well, it was on Thursday, 40%.
Wow.
Which again, I think tells you it's not just about technology this rally. It really has been a small number of very large, mostly US technology companies that have done amazingly. And lots of other technology companies have been flat. And like I said, in the Hang Seng Tech is actually down quite a lot this year. But my point wasn't necessarily to say that again. It's also to say that when you get these discrepancies, you can get big shifts when people change their mind, because there clearly is some big discrepancies in positioning. And we could see those mega technology companies come down. We could see that. But actually on Friday, when the Chinese rumors of their boosting the spending and boosting the housing market on Friday led to a massive rally in the Hang Seng Tech. It went up about 5% on Friday. So you can see swings both ways when you get these massive discrepancies in performance, like that 40% I'm talking about.
Yeah. Okay. Well, on that note, Ben, this is our last MT for June, but we'll talk again in July. And thank you for all your pearls of wisdom before you go on holiday, and safe travels in Asia, Ben. And thank you to all our listeners for listening. Thank you. As a reminder, this podcast is intended for investment professionals only and shouldn't be shared with a non-professional audience. This podcast should not be taken as an invitation to deal in legal and general investments. Any views expressed during this recording belong to the individuals and are based on market conditions at the time of the recording and do not reflect the views of legal and general investment management. Forward-looking statements are by their nature subject to significant risks and uncertainties and are based on internal forecasts and assumptions and should not be relied upon. Where individual stocks are mentioned, these do not constitute a recommendation to buy or sell any security and are for illustrative purposes only. Legal and General Investment Management Limited is authorised and regulated by the Financial Conduct Authority. For full terms and conditions, please visit our website. To find more content, you can check us out on Twitter, LinkedIn, and our website. Copyright 2023. Legal and General Investment Management Limited. All rights reserved. No part of this publication may be reproduced or transmitted in any form or by any means, including photocopying and recording, without the written permission of the publishers. This material is issued by Legal and General Investment Management Asia Limited, the Licensed Corporation BBB 488, regulated by the Hong Kong Securities and Futures Commission, for professional investors only.